Right now, somewhere in the world, someone is selling their entire portfolio in a panic. And somewhere else, someone is buying their first stock because their barber told them it's a sure thing. Both of them are about to lose everything. And here's the disturbing part. They don't even know they are part of a pattern that's been repeating for centuries. The crowd is always wrong at the worst possible moment. This isn't opinion. This isn't theory. This is mathematical certainty. When your Uber driver starts giving you stock tips, the market is about to crash. When your most financially cautious friend finally panic sells, the bottom is in. Mass psychology creates extremes. And the wealthy, they've known this for generations. They don't fight the crowd, they profit from its predictable madness. In the next few minutes, you're going to understand exactly how this works, why you've probably been a victim of it, and most importantly, how the rich exploit it every single time. What I'm about to show you will change how you see every financial decision you've ever made. The madness pattern. Let me paint you a picture. It's 1929. The stock market has been soaring for years. Shoeshine boys are trading stocks. Housewives are borrowing money to invest. Everyone knows someone who got rich overnight. The optimism is so thick you can taste it. And then, complete devastation. The crash wiped out fortunes in days. But here's what nobody tells you: the smart money had already left. While the crowd was buying at all-time highs, the Rockefellers, the Morgans, the old money families were quietly selling. When the shoeshine boy gives you stock tips, it's time to sell. This wasn't wisdom. This was a formula. Fast forward to 2008. Housing prices only go up, right? Everyone knows it. Your neighbor just flipped their third property. Banks are handing out mortgages like candy. And the wealthy, they were betting against the entire housing market. They made billions while regular people lost their homes. The pattern never changes, only the asset class does. But why does this keep happening? Why is the crowd always wrong at precisely the worst moments? The answer lies somewhere you'd never expect. Emotional extremes. Your brain wasn't designed to make financial decisions. It was designed to keep you alive on the savannah. And here's where it gets dangerous. The same instincts that kept your ancestors alive are now making you broke. When everyone around you is excited about an investment, your brain releases dopamine. You feel good. You feel safe. You feel like you're part of something. This is called social proof, and it's hardwired into your neurology. Our ancestors who followed the tribe survived. Those who didn't became lion food. But in financial markets, this instinct is lethal. Fear, greed, repeat. When markets are at their peak, you feel the most confident. When markets are at their bottom, you feel the most terrified. Your emotions are literally inverted from what they should be. The wealthy understand this biological trap. They don't invest based on how they feel. They invest based on what the crowd feels. If this is starting to make you uncomfortable about your own investment decisions, good. Hit like and subscribe to reprogram more of your money psychology. Because what comes next reveals exactly how the rich exploit your emotional blind spots. The Contrarian Code. Baron Rothschild, one of the wealthiest men in history, said something that should be tattooed on every investor's mind. Buy when there's blood in the streets, even if the blood is your own. This isn't poetry. This is the wealth code. The rich buy when everyone is selling in terror. They sell when everyone is buying in euphoria. It sounds simple, but it's psychologically devastating to execute. Imagine it's March 2020. The pandemic just hit. Markets are in freefall. Every headline screams disaster. Your portfolio is down 40%. Every instinct in your body says sell, protect what's left, run. Run. That's what 95% of people did. And what did the wealthy do? They bought. Aggressively. Warren Buffett deployed billions. The market recovered within months and went on to new highs. Those who panic sold, locked in their losses forever. Those who bought became significantly richer. The difference wasn't intelligence. It wasn't access to information. It was the ability to do the opposite of what felt natural. But here's the question. How do you actually know when the crowd has reached maximum wrong? The warning signs. There are specific, measurable signs that the crowd has reached peak delusion. And once you know them, you'll never unsee them. Sign 1. When amateurs start teaching professionals. In 2021, teenagers on social media were mocking hedge fund managers. People with zero financial education were explaining why this time was different. When the inexperienced are confidently lecturing the experienced, the top is near. Confidence without competence equals disaster. Sign 2. When people borrow money to invest in something that's already gone up dramatically. Leverage at market peaks is the financial equivalent of pouring gasoline on yourself and lighting a match. Sign 3. When the asset becomes a topic at every social gathering. When your dentist, your aunt, and your Uber driver are all talking about the same investment, institutional money has already distributed their shares to retail. You are the exit liquidity. Sign 4. New vocabulary emerges to justify insane valuations. Paradigm shift. New economy. Digital transformation. Different this time. When people invent new reasons why fundamentals no longer matter, fundamentals are about to matter very much. The wealthy watch for these signs obsessively, and what they see tells them exactly when to act. Bottom signals. Now let's flip it. How do you know when the crowd has reached maximum pessimism? When the bottom is actually in. The time to buy is when there's blood in the streets. Sign 1. When financial news becomes unbearable to watch. When every headline is doom and gloom. When experts are predicting the end of civilization. When people have stopped talking about investments entirely because it's too painful, that's when opportunities are being created. Sign 2. When your most optimistic friend finally gives up. We all have that one person who always sees the bright side. When even they capitulate, maximum pessimism is often near. Sign 3. When quality assets are being sold at any price. During true panics, people sell not because they want to, but because they have to. Margin calls, fund redemptions, forced liquidations. This creates prices that make no logical sense. The wealthy aren't buying because the news is good. They're buying because the price is right. Sign 4. When you feel physically sick thinking about buying. That nausea, that fear, that certainty that things will get worse. That feeling is often the most valuable signal you'll ever receive. But knowing the signs isn't enough. What really separates the wealthy is their framework for action. The wealth framework. The rich don't react to markets, they prepare for them. This is the crucial distinction that separates wealth builders from wealth destroyers. First, they maintain liquidity when others are fully invested. While everyone else is putting every dollar into a rising market, the wealthy keep significant cash reserves. This isn't because they're bearish, it's because they are ready. Cash is ammunition. When the crash comes, they have the firepower to buy while others are forced to sell. Second, they have predetermined criteria for action. Before emotions can take over, they've already decided at this price I buy this much. At that price I buy more. No feelings involved, just execution. Third, they ignore the noise. The stock market is a device for transferring money from the impatient to the patient. While everyone is refreshing financial news every 5 minutes, the wealthy are looking at 5-year and 10-year horizons. They understand that volatility is the price of admission for superior returns. Fourth, they study history obsessively. Every bubble, every crash, every recovery, they've analyzed them all, because the patterns repeat. Only the names and dates change. The question is, can you actually implement this? Your crowd bias. Here's the uncomfortable truth. You're not immune to crowd psychology. You've probably already been a victim of it multiple times. Think back. Have you ever bought something because everyone was talking about it? Have you ever sold in a panic because the news was terrifying? Have you ever felt like a genius at the top or like a complete failure at the bottom? Guilty. That's not weakness. That's humanity. The difference is awareness. The wealthy aren't less emotional than you, they've just built systems to protect themselves from their own emotions. 1. They have rules written down before emotions spike. 2. They have advisors who challenge their thinking. 3. They review their past mistakes regularly. 4. They limit their exposure to financial media. Most importantly, they understand that feeling confident about an investment is often a warning sign, not a confirmation. Comfort signals danger. When everyone agrees with you, when the path forward seems obvious, When you can't imagine how you could be wrong, that's precisely when you're most likely to be wrong. The crowd feels most right at the exact moment it's most wrong. But there's one more layer to this that most people never consider. Manufactured panic. What if I told you that some market panics aren't entirely organic? What if certain players benefit from creating fear at specific moments? The wealthy understand something most people don't. Media companies profit from your attention, and fear is the most effective attention grabber. Every crash gets more coverage than every rally. During market downturns, financial media goes into overdrive. Expert after expert predicts disaster. The worst possible scenarios get the most airtime. Why? Because scared people don't change the channel. Meanwhile, large institutional players can accumulate positions at lower prices because retail investors are panic selling. In the short run, the market is a voting machine. In the long run, it's a weighing machine. The voting machine is powered by emotion and media narrative. The weighing machine is powered by actual value. The wealthy play the weighing machine while everyone else is distracted by the voting machine. They're not smarter. They're just not watching the same screen you are. This isn't conspiracy theory. This is understanding incentives. Everyone is acting in their own interest: media companies, institutional investors, and yes, the experts on television. Your job is to act in yours. The generational edge. Old money families have a secret that new wealth often lacks: generational memory. They remember what their grandparents told them about past crashes. They have family stories about fortunes made by buying when everyone was selling. This institutional memory is a massive advantage. Those who cannot remember the past are condemned to repeat it. Most people have never experienced a true bear market until they are in one. By then, it's too late to learn. The wealthy teach their children about market cycles before those children ever invest a dollar. They study the Dutch tulip mania from the 1600. They analyze the South Sea bubble. They understand that human nature hasn't changed in 400 years. History rhymes forever. Every generation thinks they are different. Every generation thinks new technology or new economics means the old rules don't apply. And every generation learns the same painful lesson. The wealthy aren't betting on the future being different. They're betting on human nature staying exactly the same. And that bet has paid off for centuries. So the real question is, what do you do with this knowledge? Your action plan. Everything I've shown you means nothing if you don't act on it. So let me give you the exact framework the wealthy use. Step 1. Build your war chest. Keep enough liquid assets that you can be a buyer when everyone else is forced to be a seller. This isn't dead money, it's opportunity money. Step 2. Write your rules now. Decide today while you're calm what you'll do when markets drop 20%, 30%, 50%. Put it in writing. Share it with someone who will hold you accountable. 1. At minus 20% I buy X amount. 2. At minus 30% I buy X more. 3. At minus 50% I deploy my reserves. 4. I review this plan quarterly. Step 3. Study history deeply. Read about every major crash of the last century. Understand what people felt, what they believed, and what actually happened next. This knowledge becomes armor against future panic. Step 4. Track crowd sentiment, not crowd action. Use fear and greed indices. Monitor social media sentiment. When everyone is euphoric, become cautious. When everyone is terrified, become interested. Be fearful when others are greedy. The crowd will always be wrong at the worst times. The only question is whether you'll be part of the crowd or profit from its predictable madness. You now understand something that most people will never grasp. The crowd isn't just occasionally wrong, it's systematically wrong at the most important moments. At market tops, when confidence is highest, risk is greatest. At market bottoms, when fear is overwhelming, opportunity is maximum. Be fearful when others are greedy and greedy. When others are fearful. This isn't about being smarter than everyone else. It's about understanding that your emotions, my emotions, everyone's emotions follow the same predictable patterns. The wealthy don't fight these patterns, they exploit them. They prepare during calm times. They act during chaotic times. They think in decades while everyone else thinks in days. Decades. The question isn't whether there will be another panic. There will be. The question is whether you'll be ready, whether you'll have the liquidity, the rules, the historical knowledge, and the emotional preparation to do what the crowd cannot, act rationally when everything feels irrational. Your mind, your wealth. If you made it this far, comment contrarian below to prove you're no longer part of the crowd. Your mind is either programmed for crowd behavior or wealth behavior. Now you know the difference. If this changed how you see markets, hit like and subscribe. There's much more to uncover about how the wealthy really think.